Hi everyone, so I am up about 2.89% on my capital since the beginning of this month. It's all unrealized and I just want to talk about my positions, and I opened a new wheat position this week actually. I want to talk about why and what it looks like, and just gonna give you an update about the P&Ls, the stop losses for all the positions, and also give you an update about the futures options academy that I've been running for the past 2 weeks actually, which has been doing pretty great. So pretty much the academy is just where you can follow my trades in real time, basically. So it's kind of like a one-on-one kind of thing. There is no upfront cost to it, so it basically doesn't cost anything to get into the academy. And if you're interested, just email me below. But this is basically where I work one-on-one with people, and I can explain exactly why I open a position, for reason of entry, and then obviously we do a lot of video calls and one-on-one work. And this is the first position that I have opened. So this is the crude oil position, a short strangle, was open with 101 days to expiration, and we got a pretty good fill price. So currently, the current stop loss is actually at 25% of credit. So the position has reached 25% profit. Actually, this is not a current P&L. I forgot to update it. The current P&L is about 25% of credit. So therefore, the stop loss was also moved to 25% loss. So this position has been doing pretty well for me. It's been open just for a few days, really, from the beginning of the month and up until now. It's been 10, 11 days, and it's already up halfway through to the take profit, which is 50% profit target. We opened the position with a 40% stop loss. So not a 50 not a 50% stop loss, just because we had a pretty massive range where the price have been moving in this range since June 2023. So it's been over a year and a half where the price has been moving inside its range, and it was a really good position to open as a neutral position. Probably 95% of my trades are neutral, probably even 99% if you really look overall over the past 8 to 9 years. So it's been pretty good. And volatility was pretty flat when we opened this position. So I look at the CVOL over here, and just to show you what I looked at, volatility was actually pretty flat. So it was February 4th, so it was pretty flat. It was going sideways. So I decided it's a good time to open the position, and then obviously volatility went down, which definitely helped the position. Now, the second position that I've opened is this is silver. Again, the profit here is at about 12 or 12.5%, and actually the profit target or the P&L has reached 15%, 1.5, and at 15% of profit target, I moved the stop loss to minus 35% of credit. And again, like the other position, we opened this position with 40% stop loss because the range was so massive. And I opened it again with 113 days to expiration. Now, the reason why I opened it with 113 days to expiration as opposed to 45 or whatever number it might be is, again, because of the range, because the price has been moving up and down quite a bit. And I get asked a lot, why don't I just stick to 45 days to expiration? Well, it depends on the market. I mean, the DTE that we choose is just a tool, and for me, if the market is moving in a different way and 100 days to expiration makes more sense, this is what I'm going to do. So this position is currently up about 12.5% of credit, and again, it was open on February 4th. Now, I opened this position because volatility was good. I'll show you in a second, and it was right after Canada and Mexico got to some kind of agreement with the U.S. about the tariffs. So it was a good time for me to get into the positions. This one, the silver and the crude oil. Now, we had a massive run up actually today. Price went up 4% today. At the peak over here, the position was down about maybe 1% or 2% of credit. So it shows you how resilient these positions are if you open them correctly. And obviously the price reversed all the way back down, and we're pretty much at the same spot as we were before. Now, when things like that happen, I always want to see and look, okay, what are the news? Did something happen? Is it something fundamental? And the news that were basically nothing concrete for the price to go up all this way and stay up, and it just happened to go back down the same day. which sometimes doesn't really happen all the time. But overall, you can see the price has been moving pretty much sideways within this range since September. So they will give us about 6-7 months of range, which is really good. So anything over 3 months of price movement within our stop losses range is pretty good. And again, these are not the strikes; these are our stop losses. Strikes are either a bit wider or depending on the position. But this is the stop loss. So this is currently also the stop loss to minus 35%, because the position has profited for us. And the volatility, if you look at silver, volatility was pretty high up on February 4th, so right here, so really on the high end, and obviously went down, which definitely helped us with the position. Now the new position was the ZW position. So it was open because CVOL, the commodity volatility index, was relatively high. The range of the stop losses was amazing, and we had no crazy upcoming events. This Friday we had the USDA weekly report, which is not a big deal usually. It ended up being somewhat of a big deal, but it is what it is. In this business, the way I work, I can be wrong and still make money, which is the biggest thing. But basically, I decided to open this position on February 11th because it was right after the monthly WASDE report came out, which is the World Agricultural Supply and Demand Estimations. This report, again, sometimes it might be a big deal. Usually in winter time, might be a bigger deal, but nothing really happened on that day. But the weekly report actually gave us quite a bit of movement, and I want to show you. And currently the position is still at a stop losses of 40%. The current P&L is actually like plus 1% maybe on the position, or like 0.8 or 0.9%. Still pretty good. You can see we opened the position just like it was at the end of Tuesday. So it was at the evening of Tuesday, which technically shows you as the next candle, which shows Wednesday, but it was the evening of Tuesday. And you can see we had a massive price surge here, 3.69%. And if you look at the news, this was basically because of the USDA weekly report. And when you go through the report, you see, okay, what actually happened? Do we have like major supply and demand disruptions? And we don't. There's only like expectations that it will be really cold in Russia, which is the biggest wheat exporter in the world. So some concerns that they might not export as much as needed, so on and so forth. But again, it was a really good position, really good range. And even though the price went up just a few days after we opened the position, went up like it was 4% at the top here almost. Right, the position still managed to close the week or the day the week at plus 1%, which is just remarkable, right? And if we take a look at the volatility actually went up. But again, this is the volatility. So we opened it on Tuesday, Wednesday. So volatility was relatively high for the past few months. And even though it went up, the position is still holding up pretty well. And again, the CVOL shows you the front month for the futures. So then the month that we sold options on is July. So it's not actually the front month. So the volatility is not so these contracts are usually not as volatile, and they don't react as much to news, or their volatility is not really affected as much as the front month. This is why volatility here went up significantly, but our position is still doing really, really, really good, even though the price went up so much just in a few days. So this is the power of opening positions properly. Because you always want to put yourself in a position where you can be wrong and still make money. This is the number one thing for myself. I'm always wrong, right? But somehow I end up still coming out on top. And this is just because I'm structuring everything so it can actually happen. So I can be wrong and make money. This is the biggest thing when you sell options. And you can see the range here to the stop losses is enormous, obviously. The previous time the price was out of the range was in June, beginning of June in 24. So just about 7 months of range. So that's pretty good. And again, the range here is just enormous, just insane range. So this is pretty much it. I expect the price just is gonna go down, maybe up a bit more or down, but we have such a massive range, and the range actually already expanded because currently we're at about delta 10 on the position, which is not a big delta, but not a small delta. But you expect to be down maybe a little bit on the delta, especially after a few days. The position opened up, but we're actually up by a little bit, which is really, really good. So overall, this is it for the week. And again, if you're interested in the academy, let me know. Just email me with my email address below. I really try to provide the value there, and I do a lot of one-on-one calls. And obviously, like, there's no cost for the one-on-one calls. It's not like a upsell or anything of that sort. And I only work with like up to 15 people, really. So currently, I think that I have 8 people there that I'm working with, 8 or 7. I believe it's 8. But obviously up to 15 is what I'm looking for, because it is pretty labor intensive for me. And as always, like in any video, this is my strategy over here. Nothing too special. I sell short strangles 95% of the time. I try 45 days and less, but depending on market conditions, these are the products that I generally trade. Now, lately, I've been really not focusing on the futures currencies, because they're pretty crazy with Trump and everything that's going on. And also the meats have been pretty tough, so I'm not even looking at them for now. My short strikes are always around delta 20 for the short strangles, 20, 21, 22. And for if I sell short calls or short puts, it will be up on delta 30 to 35, usually 35. My profit target is always 50%, and my loss target can be up to 50% of credit, and it's dynamic. So obviously, as the position is profiting, I'm moving my stop losses to kind of adjust to the position. And I always use CVOL, so the commodity volatility index, to enter a position, which I talked about in this video. My exit rules are pretty simple. If one of the targets are hit, stop loss or profit target, or a 21 days to expiration, which is usually never the case, especially with 100 days to expiration positions. But I would just want to avoid gamma risk, and I can adjust the position if needed, which happens once in a blue moon, but it can definitely happen if it makes sense. I usually just take the loss and move to the next position. And I can definitely exit early if something special happens in, I don't know, maybe some kind of new tariff, something geopolitical that can really affect the supply and demand chain, or really the pricing or the demand of any one of the commodities that I trade. So I might just decide to exit early, which can happen given we have Trump in the White House. So anything can happen with him. So you gotta know your products, and what countries export what and how much, and so on and so forth. So the last thing that I will say is I'm always looking for a good opportunity where the risk is worth the reward. And I should add here, I'm always looking for positions where I can be wrong and still make money. I think it's even more important than looking for a good deal. So again, thank you so much for watching. And if you have any questions, let me know. Feel free to email me for whatever questions you might have, and I will catch you in the next one.